Hodgen, and welcome to the Hodgen Law PC International Tax Lunch. We do this almost every month on the last Friday of the month at noon Pacific time. You can listen in online, which is what you're doing now, or you can watch the show later on YouTube when we post it up there. This month's topic is, as you can see from the slide, a choice of entity topic. And this is going to be a way to subtly introduce you to the sort of how global intangible low taxed income works and how things work when you've got a generic US citizen living abroad running a generic kind of business in another country, like a dry cleaning business or something like that, purely local. And we're going to look at a few different structures and see how they perform from a US tax point of view. This is probably going to take up the whole session, the 60 minutes. So if you have a question, throw it in the chats. We'll capture them and try to respond later, or just ping me an email. My email address is on the last slide, and we'll see what we can do. In any event, let's get started. Here's the little table of contents so you can see what we're going to do. I show you the structure choices, and then we're going to walk through 4 different structure choices, all using corporations, so you can see how they perform from a US tax point of view. So let's begin. Number 1. This is the sort of template of the person we're going to be talking about. It's a US entrepreneur, so just assume it's a US citizen living in another country and wants to start a business. Same kind of thing that you have, choice of entity for a domestic person, but this person happens to be living in another country. We know for a fact that it's just going to be a business necessity to have an entity there. And we also know, because the Internal Revenue Code is what it is, that the choice of business entity type in the foreign country will have an impact on that US citizen's US tax liability. And this is because the United States insists on taxing its citizens worldwide, and in particular, these 2 lovely code sections, Section 951, which is the subpart F, income inclusion, and Section 951 Cap A, which is global intangible low taxed income, which basically say, hey, you, the shareholder, are taxable on the income of the corporation abroad. And so we have, this is like the Internal Revenue Code trying to breed a mule. Donkey plus horse equals mule. And now we've got this crossover income belonging to one taxpayer is actually taxed to another. Here are the 4 structures I'm going to be rolling through here. The first one is just shareholder owns 100% of a foreign corporation. The second one is, again, the shareholder owns 100% of a foreign corporation, but this time there is a special little wrinkle in the global intangible low tax rules called the high tax exception. And we'll see the impact of choosing or not choosing to use that high tax exception and what it does to the US shareholders' ultimate total worldwide income tax liability. The third structure is again, the same thing, 100% shareholder, but this time the shareholder makes a Section 962 election. So in the same way that you can be a shareholder of a C corporation in the United States and make an S election and radically alter the way in which the corporation and the shareholder are taxed, for a foreign corporation, you can make this Section 962 election and make a radical change in the way tax is computed for the shareholder. And finally, we're going to just use a classic domestic parent company, foreign subsidiary structure and see how things work that way. And here are my assumptions. I've got a bunch of little models, and we're going to see just what the numbers look like. And just assume $600,000 of gross revenue, 0 deductible operating expenses, except salary to the shareholder. And I will give you an example at the very end. What happens if we suck all the net profits out by paying out salary plus bonus to the shareholder? Foreign corporate income tax 30% and foreign individual income tax rate 40%. I'm using these just as sort of stylized examples of a high tax jurisdiction, an OECD country. You pick your random European country. These are just numbers that I picked out of my hat, and the results obviously will differ when you pick a real corporation in a real country with real tax rates. U.S. individual income tax rate, I'm just assuming 37%, peg the meter at the top. And to the extent that the U.S. individual shareholder receives dividends, I'm figuring, well, if the tax rates in that country are high, odds are there's a tax treaty. And so this is going to be a qualified dividend and it's going to be taxed at 20%. And of course, we've got our friend net investment income tax, that little carbuncle of corruption on the code. Not that I'm bitter about the gratuitous complexity it added, but there you are, 3.8%. All right, just to foreshadow what's happening here, you can see that in all cases, the effective tax rate when you compare the corporate income tax paid, so at the corporate level to the foreign country, the foreign individual tax paid by the individual living abroad because he's a resident of that country, the U.S. individual income tax liability because of the impact of global intangible low taxed income, Section 951 Cap A, the pass-through, and dividend income. So you're going to see these rates, and you can see that they aren't pretty. So let's go through. And I didn't mention this before, but I'm going to assume that all cash is punched all the way through the entire structure and into the pockets of the individual shareholder every year, because we don't want to have any income sort of trapped halfway. I mean, remember what life was like before Section 965, and we thought this was wonderful and it would last forever, and then all of a sudden it didn't. And a lot of people had some unhappy moments at the end of 2017 when they realized that this tax deferral, by leaving income undistributed to the U.S. shareholder, actually sooner or later the bill comes due, is what I'm trying to say. So let's just pretend that the bill comes due every year by dividend. Starting with the simplest example. So we have a U.S. person, the blue person, owning 100% of the stock of a foreign corporation. So, of course, this is a U.S. shareholder, and this is a controlled foreign corporation. The basic rules here are that the corporation's operating profit, and I'm just going to use that in a hand-wavy sense to mean global intangible low-taxed income. So active business income, so operating this dry cleaning store, is passed through to the shareholder, the individual shareholder's gross income. That's Section 951 Cap A. There's also subpart F income, that's passive income. So to the extent that the corporation had dividend income or interest income or stuff like that, that would be passed through as well. So one way or another, whatever net profit inside this foreign corporation exists, let's just pretend it's going to all come through to the individual shareholder's gross income on the Form 1040. Foreign tax credit. There are two tax credits we're going to think about. The first one is the individual shareholder, remember, is going to be paying income tax in the United States on the corporation's net income. Unfortunately, the corporation is paying income tax to the foreign country, and so this is what's called an indirect foreign tax credit situation. The individual did not pay the tax himself or herself, rather the corporation paid the tax. Section 960 is the indirect foreign tax credit rule that says a domestic corporation can use as a foreign tax credit foreign corporate income taxes paid by its foreign subsidiary. Well, we don't have a domestic corporation as a shareholder here. We have a human, and therefore the corporate income tax paid to the foreign country is not going to be allowed as a foreign tax credit. And you're going to see how this really creates some sad moments. And then finally, we've got dividends. And dividends coming from the foreign corporation to the US shareholder, remember, we just have direct ownership by the individual, is not included in the shareholder's US gross income. So you have a distribution from a foreign corporation, but the distribution is not classified as a dividend. And why is that? It's because of that code section, section 959. Remember that a dividend is paid out of a corporation's earnings and profits. Well, the earnings and profits of this foreign corporation have been taxed in the United States because Section 951 Cap A passed all of that income through to the individual shareholder, and the individual shareholder paid U.S. income tax on those earnings and profits because we have a pretend distribution of them. So when the cash follows that pretend distribution of the earnings and profits that was sort of created by Section 951 Cap A, there is no, it's already been taxed, so it's not going to be classified as a dividend. And Section 959 is where all the fun and games happens to make that happen. So this is great. So you have a lot of dividend income coming into the U.S. shareholder's pocket, and it's not included in U.S. gross income. Therefore, it's not going to create personal income tax liability. But on the other hand, you'll see that the foreign individual is going to be the foreign individual income tax on that dividend. You got your U.S. citizen living in Canada or Germany or wherever and is receiving dividend income. They're going to pay tax in that other country, and there's not going to be a U.S. foreign tax credit for the tax paid in Germany, Canada, wherever on that dividend income. So it's sort of a mixed blessing. So let's take a look here, my little diagram of how it works. We start with the foreign corporation's foreign income tax return. It's going to have gross income minus deductible expenses, and the little up arrow shows that we have a leakage here in the form of foreign corporate income tax liability paid. And we have some money left over, right? And so that's in, corporate tax land, earnings and profits is it. And we're going to take all of that extra money left over, and we're going to pay it out as a dividend. And the U.S. individuals, the citizen living abroad in Canada or Germany or wherever, is going to be simultaneously taxable in the country of residence because of those rules, local rules, and taxable in the United States because of worldwide taxation. So you see the little arrow that shows dividends coming out, going simultaneously. That income item is reported on the U.S. individual's foreign income tax return, the upper box on the right, as well as on the individual's Form 1040 in the United States. So this is wonderful. So you expect there to be an income tax liability computed on the dividend income for both of these. And to the extent that there is foreign income tax paid on that dividend, you expect to see a foreign tax credit on the U.S. individual's Form 1040, coming from Form 1116. And you can see the little arrows coming out of those two boxes to report additional cash leakage in the form of foreign individual income tax liability and U.S. individual income tax liability. So that's how that works. And so now what we will do is we'll go through applying these principles of Section 951 Cap A, the global intangible low taxed income, and the Section 959. Remember, I said dividend isn't included in gross income for the U.S. individual. And let's see how it all plays out. One final thing. That red arrow coming out of the foreign corporation's foreign income tax return, the Section 951 Cap A income. This is the artificial make pretend inclusion of income, the net profit of the foreign corporation, on the U.S. individual's Form 1040 as additional gross income on which the individual will pay ordinary income tax. So let's look and see how this all works. Starting with the calculation of foreign corporate income tax paid. Start with gross revenue, make pretend zero deductible expenses. So taxable income for this foreign corporation is $600,000. I am assuming a 30% corporate tax rate because that makes math easy. And we have a foreign corporate tax liability of $180,000, and that's paid. So that's the first. You're watching money disappear out of your pocket and go to some government. That's the first tranche of that money going away from you. Next, we have foreign income tax paid by the shareholder. So remember that the individual shareholder is living in a foreign country, is a resident taxpayer there, and is taxable on his or her individual income, which includes a dividend. So what's the amount of the dividend? Well, it's $420,000 because the corporation started with $600,000, paid $180,000 of foreign corporate income tax, and has $420,000 left over. So let's decant that out to the shareholder: $420,000 dividend, foreign individual income tax rate 40%. Again, picked for easy math. You can do it in your head and mostly get it right if you're me. And the foreign income tax paid by the shareholder, the individual, on that dividend income is $168,000. So far, this little structure has paid $180,000 by way of corporate income tax to the foreign country and $168,000 in individual income tax to the foreign country. Now let's turn to the U.S. side. The U.S. tax paid by the shareholder. The only income that the shareholder is going to have here is going to be dividend income because cash came in, and then this make pretend Section 951 Cap A, global intangible low taxed income, which we'll address next. So let's look at this, and you'll see the impact of Section 959. We have dividend income received. Well, technically, it's a corporate distribution, $420,000, and it is not classified as a dividend, as dividend income, because of Section 959. So we're going to deduct it, and so we're going to see the amount of the dividend distribution from the foreign corporation included in the individual's gross income is a big fat zero. And zero times anything, even the qualified dividend income tax rate, is zero. So the income tax liability on Form 1040 for this distribution received is zero, which is fabulous. You love to get $420,000 cash and pay nothing on it. Unfortunately, Section 959 exclusion from gross income does not apply to our friend the net investment income tax. So the unshaded little rows here in this box are the computation of the net investment income tax liability. And the reason is because the definition of net investment income is not the same definition as income for income tax purposes. So you have a different one, and therefore the exclusion of Section 959, which works to adjust what your definition of gross income is, does not apply to the net investment income part of the Internal Revenue Code. So $420,000 of dividend income for net investment income tax liability, 3.8%, $15,960 of net investment income tax. So we've got no foreign tax credit. And why is that? Well, we have this Section 904, which is the foreign tax credit limitation, which it doesn't say it this way, but the effect of Section 904 is to say that you are allowed a foreign tax credit against your U.S. tax liability to the extent of the lower of your actual U.S. tax liability or the actual foreign tax paid. So it's a min function. You pick the lower of those two numbers, and that's the foreign tax credit allowed. Well, we know because of Section 959 that the dividend income is zero, and therefore the U.S. tax is zero. And that means the Section 904 limitation says for your foreign tax credit allowable in the United States, your tax liability is the lower of zero, what you paid in the United States, or $168,000, which you paid outside the United States to the foreign country. Therefore, your tax liability is going to be zero, and for the foreign tax credit is going to be zero. And for the same reasons that net investment income tax liability is different from everything else we've done, the foreign tax credit rules don't give you any offset against net investment income tax. So sad, you pay the $15,960 anyway. So that's what's going to happen. You're going to receive the dividend from the United States, from the foreign corporation, pay only net investment income tax, and pay foreign country individual income tax, and that's it. All right. Having dealt with the U.S. shareholders, and I have a summary page where it pulls it all together. You can see everything in one place. So don't think you have to put a bookmark in your brain and try to remember everything. Because if you're like me, you have an electric buffer in your head called Eraser Man that goes and buffs anything more than 2 minutes old that you're trying to remember. Section 951A income. So this is the pretend part, and this is the fun part. Section 951 Cap A, this is global intangible low taxed income, says that a U.S. shareholder is taxed on the net income, a hand-wavy definition of a foreign corporation. And this comes from Schedule I-1 from Form 5471. And I've given you a very simplified version of this. You can see line 1, it says gross income, gross revenue, $600,000. There are some exclusions in line 2, and we'll talk about one of them, the high tax exception, the 2C, in the next example. But in this case, in our example, we have no exclusions. Therefore, gross income is $600,000. Deductions, which are your deductible tax expenses as well as tax paid. So here we only have the tax paid, $180,000, and you have this little thing called tested income, $420,000, which is the difference. And there are a few more lines below this on Schedule I-1, but for our purposes, this is all we want. And so this $420,000 is going to flow through, in my highly stylized example here, to the 1040 of the U.S. shareholder. And the way it goes through is you start with this Schedule I-1, which computes the pass-through income, this tested income, which is massaged a little bit. And then that number goes from Schedule I-1 to Form 8992, which aggregates all of the gross revenue and all of the tested income and a bunch of fiddly other stuff. It aggregates it from all the CFCs that you own, and it comes down to a single number, which is the inclusion that you're going to take over to your Form 1040. And in this case, it goes over to Schedule 1, and then from Schedule 1, it'll go to the Form 1040 included in gross income, and you compute your income tax on that. So that's the sort of flow. And so this is how it's going to look in just computed in terms of what additional tax liability the shareholder can expect to see on the Form 1040. We start with the $600,000 gross revenue. We've deducted the allocable taxes, the $180,000. So the gross income inclusion in my highly simplified example is $420,000. Ignore the standard deduction or the itemized deduction because that just makes the math messier. And we have taxable income for the shareholder, $420,000. It's all ordinary income. So let's just say that the shareholder's income is high enough to pin the meter at 37%, and the tax liability is going to be $155,400. So that's the tax liability that the individual shareholder is paying on the foreign corporation's net income. So here, let's total it all together and let's see what it looks like. Foreign income tax paid by the corporation, corporate income tax, $180,000. So these gray lines at the top are going to be all the corporate level tax problems created by the foreign country and the U.S. tax laws. $180,000 in corporate income tax paid to the foreign country, $155,400 of personal income tax paid on the corporation's net income in the United States. And then the unshaded lines below are what's happening at the personal level. Well, the individual paid $168,000 of income tax in the foreign country on the dividend income, paid zero income tax in the United States on the dividend income, remember, excluded because of Section 959, paid $15,960 of net investment income tax, and a grand total there you have of $519,360 on 600,000 of net profit. So tax rate combined worldwide 86.56%. Not bad, right? If you're in the government business, if you're a human, not so good. So having gone through that slower, we can start to speed up because it's going to be the same numbers and the same ideas and the same computations again and again with variations on this theme. Let's now look at the same structure, except the only difference is, remember, I referred to that line 2C on the Form 5471 Schedule I-1, the high tax exception. Let's see what happens if you choose that little thing and toggle it, and what does it do to the combined tax rates worldwide on everything on everybody. And this high tax exception is kind of built into this definition, global intangible low taxed income. And you say, well, what if it isn't low taxed? And what does low taxed mean exactly? Well, the short answer is low taxed means 90% of whatever the US corporate income tax rate is. So that's 18.9%. So as long as the foreign country's corporate income tax rate is higher than 18.9%, you can use this. And we're assuming a 30%, so we're good. And so it's just built in that this whole Section 951 Cap A is designed to stop U.S. taxpayers from hiding money in palm-fronted tax havens abroad, and hence the emphasis on the low taxed. And if you're in a big normal country with big normal tax rates, the government doesn't care so much because you're not doing fun and game stuff for tax avoidance purposes. I'm trying to find a polite way of saying that. Managing your tax liability to the lowest legal amount. So here we go back to the I-1, Schedule I-1 from 5471, and you can see the impact here of choosing the high tax exception on line C, 2C. We start with the same $600,000 of gross income, and from that gross income, you exclude all of the gross income that's subjected to a tax rate higher than 18.9%. And in our case, it's all of it. So this means that the total amounts of exclusions in computing the amount that's going to be taxable in the long run is going to be 600,000, which means the gross income line 4 is 0. Line 5, you're not allowed to take deductions below 0. So line 6, this tested income number, which remember goes to Form 8992 and then to Form 1040 Schedule 1 and then to 1040, is also going to be 0. So what you've done by making this choice, and it's an election, you don't have to do it, is you've immediately neutered the impact of Section 951 Cap A. So you don't remember this cost our taxpayer $155,400 before. Now we've nuked that. We don't have that $155,400 additional tax liability on the Form 1040. And here's where it shows. You see in the gray area, this is the same table as before, the gray area at the top, U.S. personal income tax on the corporation's Section 951 Cap A income is 0 because we have 0 of that kind of income. However, like everything in tax, there's cause and effect. There's second order consequences. So what you have, the good thing that happened for Section 951 Cap A income inclusion has a secondary and opposite and equal and bad effect for dividend purposes. And the clue here is, remember that Section 959 said that if you're a U.S. shareholder and you receive a dividend of previously taxed earnings and profits from this foreign corporation, then you don't include the dividend in your gross income. Well, here, because you've excluded the Section 951 Cap A income from taxation in the United States entirely by making the high tax election. All of those dividends are now from untaxed earnings and profits. Therefore, it's going to be dividend income. So let's see how that rolls out. Here's the simple way that the high tax exception works for computing income tax liability on the Section 951 Cap A gross income inclusion. So, 000 all the way down. Nice. We like this. Dividends, as I said, are received by the shareholder, and they are taxable dividends because the earnings and profits from which this distribution was made were not previously taxed. Therefore, Section 959 does not give us coverage and give us the ability to exclude it. So this is great. However, we're going to do two things. One, you're going to see how the foreign tax credit comes back into play, because now that we're paying some actual U.S. income tax, now the Section 904 thing that said so long goodbye, you can't use any of the foreign income tax on that dividend income as an offset in the United States. Now we're going to be able to use it. So here's what we're going to do first. We've got a $420,000 dividend received by the U.S. shareholder. We're going to assume it's a qualified dividend. Why? Because with a country with income tax rates that high, it's got to be a country that has a U.S. income tax treaty, and therefore the dividend will qualify for the qualified dividend rate. So 420,000 times 20%, 84,000 of income tax for the U.S. shareholder. Again, net investment income tax on the dividend, 15,960. So far, so good. Now, onward to the foreign tax credit. Remember that Section 904 says if you are a U.S. shareholder and you have income and it was taxed in a foreign country and it was taxed in the United States, you can claim a foreign tax credit to the extent of the lower of what you paid in the U.S. or what you paid abroad. And in this case, the lower amount is the U.S. tax liability, $84,000. So we're going to have a foreign tax credit allowable against that dividend income of $84,000. And here's how it works. Again, the gray shaded rows at the top are the corporate. $180,000 of corporate income tax paid. The indirect foreign tax credit allowed to the individual shareholder. Sadness, Section 960, you don't get any benefit, so that $180,000 is gone. But this time, no income tax for this corporation's Section 951 Cap A income. Good news. Now let's look at the unshaded rows, which are the personal side of the equation. $168,000 went out of pocket to the foreign country for personal income tax on the dividend income. And we have offsetting amounts. We have $84,000 of income tax in the United States, offset entirely by an $84,000 foreign tax credit on that dividend income. And so that washes out. And the only U.S. tax cost is the dividend, the net investment income tax of $15,960. And now you see this is a much less bad total tax liability worldwide of $363,960. So almost, roughly 61% combined worldwide tax load, all things added together. Better. All right, next, onward. This is going to yield the same result as the high tax exception in a different roundabout way, but we'll see how it works. So again, I said, remember, you have this idea of you have a domestic C corporation, you make an S election, and it changes the way that the corporate profits are taxed and the shareholder is taxed. Same idea with Section 962. You can do this for a controlled foreign corporation if you're a U.S. shareholder. And there are three big differences that happen here when you make this election. The first thing is you continue to include all of the operating income as well as the subpart F income in your gross income as a U.S. shareholder. So that's normal. Second thing that happens, which we didn't see before is you get an arbitrary and completely made up 50% deduction against that gross income inclusion. And this is section 250. You don't get this as a human being, but you do get this if you make the section 962 election. And why is that? It's because the section 962 election tells the IRS, I'm a human being. I want to be taxed as if I'm a corporation on the subpart F income and the global intangible low taxed income. So we pretend that you are a corporation, therefore you are entitled to take the section 250 deduction, which is allowable only to corporations. Next, the nominal tax rate. Remember, you're pretending you're a corporation, so you get to use the corporate income tax rate, 21% instead of up to 37% for human. Yay. And now when you combine the effect of the 21% tax rate and you say only 50 cents on the dollar of that gross income inclusion is actually being taxed, the effective tax rate is going to be 10.5%. Way cool. Subpart F income, just as an aside, this section 250 deduction doesn't apply to subpart F income, so your effective tax rate on subpart F income is 21%, still better than 37%. So here's my little comparison. I'm going to be building this all the way through so you can see the pluses and the minuses. Green is good, red is bad. So tax rates, much better if you make the section 962 election. Second thing is dividends, if you make the section 962 election, will be included in your gross income. This section 959 thing that we were relying on before to exclude the dividend from gross income, you throw it out the window. You include most of the dividend as gross income to the shareholder. And that's just the way it's going to go. And I say most of, and I give you the little language from section 962D there. We're going to cheerfully ignore that, and we're just going to do easy math because this is the spherical cow example, right? The physics professor trying to demonstrate principles of physics and saying, assuming a spherical cow weightless floating in a vacuum, and then let's compute what happens, under this principle or that principle. So dividends included in gross income? No, under the default methodology, that's good. And mostly yes, that's bad for the section 962 election. And then the final thing, and this is the cool one, in my opinion, is that because you are pretending to be a corporation, because you made the section 962 election, you are allowed to use the indirect foreign tax credit, section 960. So this means that the $180,000 of corporate income tax under the previous example that just went completely to waste, now we are going to be able to use some of it as a foreign tax credit. So let's see how that rolls out. Anyway, so here's the third one. Green light for the section 962 election because we get a foreign tax credit where we didn't under the other way. And here's how it all stacks up. It's a 2-to-1 game, and let's see how the math works. Okay, first, the section 951 cap A income, the pass-through. Again, same numbers, 420,000 coming through. We have to add back the 180,000 in taxes paid by the foreign corporation if you want to take the indirect foreign tax credit. So we do that, and we say we have a $600,000 gross income inclusion minus this make pretend section 250 deduction, which is only there for political reasons. A spoonful of sugar let the, what's it say? The spoonful of sugar makes the medicine go down from Mary Poppins, right? So Congress gave us this to make us swallow the whole big 2017 Tax Act. So you have taxable income of $300,000, tax rate 21%, corporate tax rate, remember? Tax liability of $63,000. And remember, in the first example, it was $155,400. So this looks better. Now let's look at the impact of the indirect foreign tax credit, which we couldn't take before. Section 960 says, now you can take the indirect foreign tax credit against section 951 cap A income, but you can only take 80% of it. So they paid, the corporation paid $180,000. 80% is 144,000. And remember, again, Section 904 says you're allowed to take the lower of the two, U.S. tax or foreign tax paid. We take the lower of, which is the U.S., 63,000. So we have an allowable indirect foreign tax credit for this human being of $63,000. Dividend income. This was the red light, right? This is the bad stuff. We have dividend income of $420,000 to the individual. It's a qualified dividend, $84,000 of tax liability. Again, net investment income tax, $15,960. But the individual paid income tax in the foreign country, $168,000. So Section 901 says this is the direct foreign tax credit. You, individual, paid tax in this other country, as well as in the United States on the dividend income. So we'll give you the lower of the two. So U.S. tax liability was $84,000. Makes sense because the income tax rate is 20% here, 40% in my example in the foreign country. So we've got a foreign tax credit flow through. So even though the dividend income is taxable and created a tax liability, we have a companion foreign tax credit, which, as you can see from this total everything paid by everyone everywhere, the white zone up at the top is the tax liability paid to the other country. So $180,000 for corporate and $168,000 for the individual income tax liability. And I wanted to show you how largely, except for the net investment income tax liability, all of the U.S. tax liability washes away. The dividend income liability washes away because it's offset by the foreign tax credit, this direct foreign tax credit. And the U.S. personal income tax on the global intangible low taxed income, again, is washed out by the indirect foreign tax credit of Section 960. So it's a good result. And as a general principle, I'm thinking that Section 962 is probably going to be your best bet if you've got a human being living in a foreign country running a normal business in a corporation because that's expedient for the local purposes. It's going to be as efficient as you can get, my belief is. So for what that's worth. Finally, I'm going to go through a quicker domestic parent and foreign corporation situation. So what happens if you say, well, I'm just going to do a corporate reorganization and slot a domestic parent between me, a U.S. citizen, as the 100% shareholder of the parent corporation, and the foreign subsidiary, operating subsidiary with operating income, passive parent company, just a holding company. What does that do? Does that create anything wonderful? Is it good? Is it bad? Should I do this? The first comment that I have is that if you do this, it might look wonderful for U.S. income tax purposes, but it's probably going to create more complexity in the foreign country. So think of it this way. If you have a U.S. citizen living in Germany, owns a German company that's classified as a corporation for U.S. income tax purposes, what does the German tax compliance for that corporation and the individual look like? Fairly straightforward. What does it look like for the individual and the corporation if you have a U.S. parent company with a German subsidiary that's operating? All of a sudden, even if the tax liability is higher or lower, and I don't know what it would be, you have just an order of magnitude more paperwork because you have a foreign parent company. So in general, I would say you're going to avoid this kind of thing for regular ordinary businesses run by regular ordinary people. Again, same assumptions as always. We're going to distribute money out, decant up money up all the way through until we come to the shareholder. And you can see here, we're going to follow this path. It goes counterclockwise in my little map here. Start with the corporate income tax return. It's going to be the same numbers as always, $600,000 of income, pay $180,000 of corporate income tax. Money's going to get decanted down to the U.S. parent company. We're going to compute corporate income tax for the U.S. parent company. Whatever's left over is going to be a dividend. Dividend is going to get paid. It has to be reported on the individual income tax return in the foreign country and in the United States. Now, in this case, the individual in the foreign country is going to be looking at foreign source dividend income, right? If you're living in Germany, you're receiving a dividend from a U.S. corporation, and that's what the German tax authorities are going to be seeing on the individual tax return. So that's going to make a difference in the way that the tax credits work. From the U.S. point of view, it's just a qualified dividend received by a U.S. shareholder. No big deal. What that's going to do is you can see on the arrow between box 3 and box 4 is that the tax credit is going to flow from the U.S. and it will be claimed on the foreign country income tax return. And in order to do that, I'm making a heroic assumption that this random mythical foreign country that I'm making up has the equivalent kind of foreign tax credit rules that we experience in the United States. So that's how the whole flow will go. And let's just look at the same old numbers as before, and we'll see what they say. Again, back to the same old deal. First things first, we're going to pay $180,000 of foreign corporate income tax at the operating subsidiary level. The domestic parent, we're going to have the Section 951 Cap A income. And remember, because of the indirect foreign tax credit, we have to gross that income up by the corporate income tax paid. This is Section 78. And so that is going to be gross income flowing through to the Form 1120 for the domestic parent. And remember, we had the Section 250 deduction, which is just an arbitrary 50% against the inclusion that we described here, which is going to be $600,000. By the way, that deduction goes away in 2025 or 2026. It reduces to 37.5%. And I'm sure as soon as Congress decides they want more money from us, they'll make that deduction go away entirely. So that's what's going to happen there. And now let's look at what happens on the parent side. We have gross income inclusion. Let's see, gray zone. We have the same number as before. You saw the gross up of $420,000, effectively the earnings profits of the foreign corporation, grossed up by the tax paid. So the inclusion amount is $600,000. You subtract 50% of that, the $300,000, because of Section 250. So the shareholder, in this case, the shareholder is a C corporation, has taxable income of $300,000, has a corporate income tax rate of 21%. Corporate income tax liability is $63,000. Same as the Section 962, to nobody's surprise. Indirect foreign tax credit. You remember, Section 960 says that in a parent-sub relationship, a domestic corporation can claim the indirect foreign tax credit for foreign income tax paid by their foreign subsidiaries. So we're going to use that now, and we're going to see what the impact of that is on this $63,000 of corporate income tax liability that we computed on the previous slide. Start again at the top. Paid $180,000 to the foreign corporation to the foreign country for corporate income tax liability. Section 960 says, yes, you can use the indirect foreign tax credit, but for this global intangible low taxed income stuff, you can only use 80%. So we're going to have $144,000. That's the make pretend amount that for global intangible low taxed income purposes, we're going to pretend that was actually paid to the foreign country. The actual tax liability in the United States, by contrast, is only $63,000. So you remember that was the calculation. Total inclusion, divide by 2, because you got the 50% deduction, times 21%, $63,000. Section 904, the limitation on how much foreign tax credit you can claim, applies equally to the direct foreign tax credit. I paid the tax in the foreign country, I get to claim the credit, as it does to the indirect foreign tax credit. My subsidiary paid the income tax to the foreign country, I get to claim the foreign tax credit. So 904 applies both places. It's the lower of US tax or foreign tax paid. The lower of 63,000 and 144,000 is 63,000. Even I can do that math. And therefore, your foreign tax credit allowable is 63,000. Dividend income to the foreign parent, 100% dividend received deduction. So this is not going to affect the corporate parent's tax liability at all. So what we have for taxable dividend income on the Form 1120 is a big fat zero. So what you can see there, I didn't do a summary number, but forgot. You have corporate income tax paid by the foreign parent, by the domestic parent, pardon me, of zero. We had a $63,000 liability. We had a $63,000 indirect foreign tax credit, net payable zero, and $420,000 in the bank, which we are now going to pay out as a dividend. And let's see how that dividend hits the foreign individual income tax return and the US individual income tax return and how it all nets out. So first, for the individual in the United States, this is normal stuff. You know, Delaware Corporation pays a dividend to its US citizen shareholder, $420,000 dividend, income tax liability $84,000, net investment income tax liability $15,960, $99,960 total out of pocket. Foreign income tax. Again, you think about your mythical U.S. individual citizen shareholder running a dry cleaning company, you know, in Germany, and received a $420,000 dividend from a U.S. corporation. Drops on the individual income tax return, 40% tax liability, $168,000 of foreign individual income tax paid. Now, you remember I made a heroic assumption that their foreign tax credit rules applicable to individuals apply roughly equivalently to the way that we do it. I've made one slight variation on that, and that is I have assumed that because maybe the income tax treaties are not up to date, or because the foreign domestic income tax laws are not finely tuned to the way that US tax system works, is that they will not make a distinction between net investment income tax paid, the $15,960, and regular income tax paid. And therefore, the entire amount of tax paid will be a creditable value against the foreign income tax liability on the foreign income tax return for the individual. And that means that the net foreign income tax liability at the end of the day is going to be $68,040. So one of the things just to remember, you know, again, remember this is a spherical cow example, you know, on slides, and we're going fast, and your situation and your real client and the real country and the laws of the real country and the treaty between the United States and that country, they're all going to matter, and they're all going to make a variation. But I hope at least you see how the puzzle pieces put themselves together so you can do the math for your own situation. So here's my, you know, hand wavy disclaimer for why you're going to do it this way and why the entire creditable amount is going to be applied on the other country side. So what I have here is in the parent substructure, we've got some good stuff happening. And what you see at the end of it is that, as you expect, if you knew nothing about it, but you knew about foreign tax credit generally, you know this principle of Section 904, that in general, when you've got somebody who is entitled to a foreign tax credit, your total worldwide tax liability is going to be the tax rate of the country where the tax rate is higher. And that's either the United States or the foreign country. And indeed, this is what happens here. The foreign corporate income tax paid is 180,000, and the U.S. income tax paid on the corporation income, so 63,000, is washed out by the indirect foreign tax credit. Similarly, the shareholders' foreign income tax paid on the dividend income, 168,000, the U.S. tax liability, because the tax rate is lower, is entirely washed out by the foreign tax credit allowable on the foreign country's income tax return. And so what we end up with is the total tax paid worldwide is simply whatever was paid in the foreign country, and your U.S. tax return ends up to be a big fat zero. So quite often, the parent sub is going to be a useful structure to look at in terms of efficiency if you are looking at a situation where that does not create a mess in the other country. So let's look at this and sort of wrap it up. I've got one final idea for you, and this is from the bad old days when I was a young pup lawyer and before I sort of semi-banned all entertainers from my practice. You'd have these things called a loan-out corporation. So a musician or an actor, let's say an actor was going to be on a movie, and the producer says, I'll pay you $1 million to be in this movie. And the actor would say, great, but pay it to my corporation. And the corporation would then lend the services of its sole employee, the actor, to the movie production for $1 million. And so we would run it through. And the loan out corporation would zero out its income by paying $1 million salary to the actor. And in the bad old days, we're doing that because we're trying to stick away money in pensions and stuff like that. So what about here? Let's play the same game here. We have 600,000 of gross revenue. We have zero deductible expenses other than salary. So let's just salary and bonus out the entire net profit of this foreign corporation to the shareholder and see what happens. First thing we see is it's impossible for there to be any global intangible low taxed income because we've manipulated the financial statements of this corporation so the P&L says a big fat zero. Second thing is, what happens on the corporate side? Zero corporate tax. And what happens, we just zeroed out the Section 951 Cap A income. So the corporate side is a wash. Now we've got a human being with $600,000 of salary income. What happens? Under my highly simplified example, we've got foreign personal income tax liability at 40%. $240,000. We have U.S. personal income tax rates at 37%, so $222,000. We know because of Section 901, the direct foreign tax credit, and Section 904, which is the limit on how much tax credit you can take, that the allowable foreign tax credit is going to be the lower of the two. So in this case, the U.S. tax liability, $222,000. And the only income tax cost we have is the individual income tax liability imposed by the foreign country on that $600,000 of personal services income. So, going back to my little table that I gave you at the beginning and adding at the bottom this row, I would say that if you've got a choice between, let's just say, real world solutions to tax problems and clever lawyer tricks to tax problems, high tax exception, Section 962, parent sub, all this BS, why don't you look at real world solutions, just along, for instance, the way we're doing it right now. It might not solve all of the problem, but for instance, in any one of these examples above, if you paid a reasonable salary out and the only tax you're going to be paying there is the 40% individual tax rate in the foreign country, you're going to be reducing the effective worldwide tax for this person substantially, and it's going to be worth it. So, with that in mind, I've hit the 60 minutes. Here's the disclaimer and all of that. Don't blame me if you shoot yourself in the foot. But on the other hand, here's my email address. Love to brainstorm. And if you have any questions, comments, and whatnot, send me an email. And with that, this is the last session of calendar year 2022 because we ain't doing nothing over the Christmas break. Our next session will be on January 27, 2023. Deborah Rudd, CPA of our firm, who does a lot of expatriation work, will be talking about probably the most critical element of expatriation tax planning, which is the net worth test. So again, that's January 27, 2023. Be here and listen in. If you're not on the mailing list, go to hodgen.com, sign up for the mailing list so you can get announcements for when these things are coming in. Anyway, thanks so much. Have a happy Thanksgiving. Talk to you in the new year. Bye.